Thank you all. Great to be here. Little bit about me. I'm the executive director of InnSure. InnSure, we are a mission-driven nonprofit, and our mission is to innovate insurance. And we look at that through the lens of what the world needs. And we have 4 impact pillars. How can we close the protection gap? How can we accelerate the transition to a low-carbon economy? How can we improve community resilience and promote nature-positive practices, all through better insurance products and services? And we're super excited to moderate this panel. Resilience and promoting more resilient communities and businesses as a key part will enable us to build better products and services. And we're going to jump into it and introduce our panel. To my immediate right is Stacy Swan. She has 25 years in climate finance. She is CEO and founding partner of Climate Finance Advisors. She is also an active board member on the Montgomery County Green Bank, and also the Export-Import Bank of the United States, and also has recently launched Resilient Earth Capital, an angel group focused on early stage investments in climate. To the right is Carmelina Borsellino. She is the Vice President and Chief Engineer of FM Global. Her responsibilities are strategic and technical direction and development of expertise and resources at FM. She also started as a loss prevention engineer working with Fortune 1000 companies. And she's going to talk a little bit about what FM's doing, but FM is completely committed to that loss prevention role, which has largely disappeared from the insurance industry, and it's a really important role, so we're super excited to hear about what FM's doing in that space. I'm going to put the first question to Mel. Understanding the role of insurance in climate, and specifically talk about R&D and resilience and mitigation and how who your company serves and how they engage.
So FM Global is a property insurer. It's based out of Johnston, Rhode Island, and this essentially is our business model. We have the belief that the majority of losses are preventable, and our biggest differentiator as an insurance company is the engineering. So we help our clients and any prospective clients really assess, identify, and improve the risks by offering them, specifically climate risks, by offering them research-based solutions to help them mitigate the risk. So we've been doing this for a very, very long time, and we are continuing to invest in research, climate science, in engineering, in approved products and technology to really be able to lead in this space and really help our clients understand and quantify that exposure for them.
Stacy, talk a little bit about how your customers see the role of insurance.
Yeah, so thanks, Charlie, and it's lovely to be here and lovely to see you all in the audience. So I have been working in the financial sector for most of my career, and at Climate Finance Advisors, which was a firm that I was CEO of for about 8 years. We actually were acquired in 2022. But our clients were investors of different types. So they were banking, in the banking sector, they were private equity investors, and the role of insurance came up over and over and over again when it came to those investors trying to figure out how their value at risk could be managed through insurance products. There still is a lot of education that needs to happen among the investor set around insurance as a risk transfer tool, not a risk management tool. And this is why firms like FM Global and others are so important, because you actually cannot use insurance to manage your risk. Risk is transferred through insurance products, but you don't reduce your risk unless you also do the physical retrofits, particularly for physical climate risk, the physical retrofits that are needed to build the resilience of that asset so that if a disaster happens, the value is protected. So you need both. And that's one way that the insurance industry and the insurance business can actually be very helpful around this issue.
Yeah, and one of the things, when you talk about you need both, the insurance industry is extremely good at the risk transfer.
That's right.
Companies like FM Global are extremely good at the transfer and the mitigation. The scale of the losses and the frequency of the losses, I read a stat this week that the frequency of billion-dollar losses on average, about 15, 20 years ago, they happened every 82 days on average. That frequency has gone from every 82 days to 18 days for billion-dollar losses adjusted for inflation. And that's being driven by a number of things, including the size, the intensity of the catastrophes, the dollars at risk all aggregated, where people live, where people work. And it kind of leads to my next question about innovation. You can't just keep transferring risk as it's getting bigger and bigger. So mitigation needs to be a bigger part of everything. And the way people mitigate needs to be a bigger part of everything. So what is happening that is different and innovative in the space? What are customers kind of talking about? Kind of talk a little bit about innovation from your side and new tools and techniques and approaches.
Sure. So like I said, right, we've been assessing this risk for our clients for a very long time, but this topic has just become top of mind. And our clients have an emerging need to really understand their exposures a lot more on a portfolio level. So we heard them loud and clear. So what we did is we developed a couple of products starting last year. And one of them is to really, we've been collecting all of this information on a location level with our boots on the ground field engineers, but they wanted to see it more on a portfolio level. So we developed a report called the Climate Risk Report, which really gives them a current view of their climate risks. And it offers them also prioritization of those risks. So we kind of compile all of their location risks, add an element of AI, machine learning, and advanced analytics to give them really a prioritization of inherent and actionable things they can actually do for physical climate risks, and then be able to prioritize them and be able to act on them. So that's one product, current view. But there's climate change on the horizon. It's here, and we're talking more about it. So we developed another product, which was just released this year, the Climate Change Impact Report, which gives them a future view of risk based on some chronic and acute risks based on 5 extreme perils, and giving them a future view in 2030, 2050, so that when you take their current view of where they have their exposures, using that future view, then you can use it to, okay, where should I be prioritizing my dollars, my costs, my capital, in terms to be able to build in resilience on the locations that really matter. And then we also came out with another report because more and more our clients, specifically in Europe, are being asked to report on climate risks disclosures. And so what we did was we developed a climate reporting aid that really exemplifies and shows and demonstrates the clients how they can use data and information from the climate risk report, the climate change impact report, to be able to report on their climate-related exposures, and it links it to a widely used framework, which is the TCFD, which is the Task Force for Climate-Related Disclosures. So those are the 3 products that we invested in and we developed and released last year with the Climate Change Impact Report this year as well. So this is, we feel, is really, really helping our clients prioritize and mitigate their risks.
And just a quick follow-up question. If your customers are taking in all these awesome analytics, and you said it's all actionable, they can invest in making their operations more resilient, what does FM do? Tell them about how you incentivize the action part to use those reports for their benefit.
So our clients have always mitigated their risks, but we maybe had to give them a little bit of a push. So we developed and released a resilience credit last year, and we just did it again this year. And the resilience credit, it's about $350 million that we are essentially giving back to our clients to invest to help mitigate climate risk. It's essentially a 5% premium offset that we give each client, and then they use, the expectation is that they use the information we provide in the report, specifically the climate change report, to be able to use the resilience credit to help improve the risk, and using the report to prioritize where they need to spend their dollars. So we did that. This is the second of its kind, and it's effective again October 1st to September 30th of 2024. And we've seen a vast improvement. In fact, we are on pace to reduce about $20 billion in exposures just by clients who have used the resilience credit to help mitigate climate risks. It's record pace.
And those returns accrue over time because the resilience, once
exactly,
you invest
we're
in
helping
it,
the clients.
it's there.
Because the climate risks more and more are becoming more frequent, and they can have a huge financial impact to their businesses, and they are acutely aware of that.
Cool. Stacy, talk about the customers that you deal with and innovation and resilience and how they look at some of them.
Well, I'm going to pick up a little bit on what Carmela said, because this is an amazing, I actually really do want to kind of applaud FM Global for doing this, because in the climate and investment space for the last 10 years probably, we've been talking about how important insurance can be, not just in signaling. They are a price signaler in the market. Mm-hmm. They're a price signaler for everybody if you're paying attention, but most people aren't really paying attention to the signals that they're sending. But not just being a price signaler, they can actually incentivize behavioral change. And one of the things that they've done very well in the health insurance space is to kind of start to integrate essentially what you've just talked about, to incentivize people to stop smoking and maybe have a healthier kind of lifestyle. But doing this for climate-related physical risks actually is really, really important, because it both raises awareness and understanding, but it also has a financial incentive. Insurance, as many of you may or may not know, prices itself every year. So insurance pricing can be reset based on an insurer's understanding of risk-adjusted cost for a certain peril that they're underwriting. And if you are sitting in Florida, or you're sitting in Phoenix, Arizona, or California, Northern California, where the wildfire risk is increasing, you might be looking in the backwards mirror and thinking, gosh, my insurance is doubling every year for the last 3 years. And before that, it didn't really move. The curve of that price adjustment is a price signal, right? Insurers are in the business of underwriting you and selling insurance products for perils for a short period of time. They have a 1-year time horizon to sell you that product. They actually know a lot more about the trends of physical climate risk than they are telling you, because that's their business, right? But if you're paying attention to that price signal, you're starting to realize the affordability is changing around certain hazards. The availability is changing. Maybe it was covering 80% of losses under a certain hazard 5 years ago, and now it's covering 40%. Those small changes are actually signals to you as a consumer or as a business owner in the market. Now, investors, so the people that I deal with a lot who are thinking about climate-related financial risk of a portfolio, and maybe I'll just take a moment to say one of the most innovative things that has happened since 2015 has been the Task Force on Climate-Related Financial Disclosures. It is a disclosure framework. It is voluntary currently in the United States. It's now being wrapped under another framework called ISSB. It may or may not be perfect, but what it has done for the investor set, it has given us a common language to talk about climate-related financial risks. And so you can go to your insurance company, or you can go to companies like FM Global or any of the actuarial companies that sit behind insurers, and start to ask the right questions about these hazards, how they're changing, what their risk profile looks like from a physical perspective, and then crosswalk that into your portfolio or your investment decision-making process, which is really important, into the financial exposure you might have. And what has been game-changing around climate change. The other thing that's happened since 2015 is climate change has come closer. We used to think of climate change as a 2050 thing. It's now much closer. We will probably pass 1.5 degrees in the next couple of years. So investors are starting to think about this as a real thing that they need to manage now, even if their time horizons for what they invest in is 3, 5, 7 years. They're really starting to think, okay, I've got to start thinking about how this affects investments I'm making today, or investments I'm sitting on, which brings us full circle back to the boots on the ground and the things that people have to do to retrofit. Insurance can transfer your risk for 1 year, but it cannot make your house fireproof or put in the swales around your house to make sure your basement doesn't flood. That is investment that has to be made.
It's absolutely investment that has to be made. But one of the super clever thing about the FM model is it creates this positive kind of reinforcing cycle that maintains and preserves the market that they're selling to. And the companies that are just the canary, sending the price signal but not creating that incentive loop, you know what happens to the canary.
Absolutely, and this is really, really important because if any of you follow the insurance markets, and I'm sure some of you do, what's happened in Florida in the last year and a half? I think 13 or maybe more, I'm not tracking it on a daily basis, more. Someone's saying a lot more. 13 bankruptcies, 20 bankruptcies? 17 bankruptcies of insurance companies because, again, if you're in the business of underwriting, you've got a group of people who are just out there incentivized to sell product, right? But putting that loop together actually keeps the insurance as a financial mechanism is an important tool for financial resilience as well, not just physical resilience. And those houses and homeowners and companies in Florida that now no longer have access to insurance are now going to carry some really striking risk on their own backs, which, by the way, ends up on the public balance sheet anyway. Right? So this becomes a taxpayer issue if we don't have really healthy and deep insurance markets. And the complementary action to the actual financial product is the retrofits and the investments in building the physical resilience to some of these things.
And the insurance companies that invest in R&D and invest in kind of climate reality models are the one that are not just going to be able to exist through the hard markets. There's going to be incredible new markets that emerge. We're working on some things at InnSure around community-embedded insurance and ensuring the transition in different ways. So it is not just preserving the existing markets, but it's really kind of engaging in a way that they can capture new markets.
Right.
So,
and there's a protection gap question here.
There's a huge
protection gap issue. Kind of the affordability question is going to mean that those who bear the brunt of climate change the most anyway also have the least financial wherewithal when insurance goes away. Or when insurance not just goes away, but when it reduces its coverage. I mean, if your coverage was 80% of a rebuild in a place where you have wildfire risk and is now 20% because the insurers have to stay in the market, that doesn't cover you when your house burns down. It's really not the same.
It's not sustainable. The risk is going up, and the just increasing price and reducing accessibility of insurance, the protection gap is heading towards $1.8 trillion. And the protection gap, if anybody doesn't know, it's the difference between economic losses and what's actually insured. It's large and it's growing, and it's the size of the insurance market. If you can figure out ways to deliver insurance to that group using innovative things like analytics and mitigation and boots on the ground kind of consulting with individuals, enterprises, and communities, that's $1.8 trillion worth of market that can be accessed by the insurance industry. And if you're innovative, you can do it profitably. We have about 10 minutes. I want to talk a little bit about customer perspectives. You all are kind of deep in this space. What are you hearing from the people that you're engaging with, the customers and other stakeholders? Is this a top-of-mind issue, or is it like, oh, this is a 2050 issue? And how has it been changing?
I think from my perspective, I started in this role about 5 years ago, and we weren't really, we were talking about natural hazards. We were assessing for natural hazards as part of our evaluations for our clients. We weren't even talking about climate change. Now, 5 years later, the conversation is completely different. It is so top of mind for our clients, and they are very interested because they see it. It's in the news every day. You hear about, we are having many, many more disruptive events. You have these surprises in areas that you don't normally see, like in California and other areas. So it is becoming, so we are having lots and lots of conversations, with our client service teams, in terms of addressing, and clients wanting to understand, where do I have my exposures? Where am I vulnerable to climate risk? Because I need to do something about it. Because they know with everything that's happened, even post-COVID and global supply chains, if you are down for any reasons, it is a financial risk, and it can affect the livelihood of your business. We have one client, just an example of our resilience credit, one R&D facility. They do 3D printing of lungs. This is a critical health issue, and they use a resilience credit to build in their protection for flood, which was a temporary barrier. So they use the resilience credits dollars to be able to do that. And so they are now protected, and so they know that this affords them the continuity in their businesses. And so if there is a flood, they know they will be able to be resilient and stay in business and be able to provide this critical service from a health issue.
Can you talk a little bit about how the investment community used some of these?
Yeah, no, I think over the last kind of 7 or 8 years, awareness has increased. Understanding, it really depends. There's some investors who are very much kind of aware that climate change is a financial risk, that climate change comes in many flavors. There's physical, and within physical risk, you have acute and chronic. Correct. And then you have transition risk, which is, the energy transition and stranded assets and the like. And within the physical kind of space, I will say those investors who were really getting their hands around kind of physical risk and the role of insurance are now starting to think about climate physical risk in ways in the kind of chronic space. So not just kind of, do I have an acute event, a storm, a wildfire, something that's going to kind of cause me losses or damages to my business, but what does a business sitting in Phoenix, where today there's 30 days of extreme heat, and in 5 years there's 90 days of extreme heat, what does that mean for my revenues, for my cost basis? Cost basis is a really big driver of this. What does it mean in terms of my cooling needs, my cost for cooling, my energy needs? And the insurance industry is kind of starting to innovate around that. We think of insurance for climate risk usually in acute physical impacts, but I do think there's some really interesting things that are coming up around the chronic kind of conditions that a warming planet will bring to many businesses, for example. I also think that investors who are specifically kind of advanced in their understanding about climate change as a financial risk are also starting to really model in, and this is kind of exciting for me, but really model in insurance cost adjustments in the future. So they're trying to figure out where the insurance industry is going to go, because they're starting to do the backcasting that I mentioned, see some of the slope in terms of the increased cost, and say, okay, if I'm going to invest in this portfolio of real estate assets, what's the insurance cost carry for my 10-year investment, and what's that going to look like? And that's pretty advanced kind of thinking around how to manage climate risk from a financial perspective, and what it's going to mean for holding that portfolio. So
another area that we're looking is really leveraging technology. I mean, our motto has always been boots on the ground. We visit our client locations, but really is how can we leverage imagery, technology to understand climate risk for all locations that we insure for our clients, those that we visit and those that we don't visit, and really be able to give them a full understanding of all the locations that we insure across the globe for them. So we're investing a lot in technology to be able to do this as well.
It's super interesting when you talk about the kind of that full picture, and you're talking about the investment community starting to model the insurance costs. One of the things we think about a lot and that we are launching some programs around is this notion of there is a total cost of risk, which is related to, you know, the mitigation investments, the risk transfer costs through insurance or other mechanisms, and also the recovery or the impact. Those costs, other than like the federal government insurers of last resort, they don't really roll up to anybody. So I wanted you're itching to comment on that.
Because this has also been a really interesting kind of mind shift in the last couple of years. In the climate world and the climate investment world, for a long time, adaptation and resilience. So first of all, everyone used to call it just adaptation. Now they call it adaptation and resilience. But people used to say, oh, that's not cost recovery. That's actually, any investment in adaptation is not going to kind of pencil out from a commercial viability perspective on an asset. That is absolutely not true today if you look at the total life cycle costs and you consider costs, increasing costs of insurance, and you consider the potential losses. So there are a number of investors, particularly in the infrastructure space, who are starting to understand this and integrating climate-related financial risk into cost-benefit analysis, which is starting to essentially, you know, put the baseline versus kind of the resilient asset together, and you realize actually the baseline is more at risk for losses and being kind of not a commercially viable asset than actually spending the money to build in the resilience to X, Y, or Z hazard, depending on where you are. I'll also say physical risk for climate change is hyper-local, and some investors really weren't thinking about hyper-local for the most part, and this has made them think about hyper-local, which has made them ask the right questions about boots on the ground, retrofits, what is the infrastructure that's needed, whether it's a big asset or even a building or a home. And that's also important because we're not going to be able to build the resilience to 1.5 or 2 without building the resilience to 1.5 or 2. This is not just a financial architecture question.
Just one more quick question, Stacy, and we have like 2 minutes, but you talked earlier about the temporal mismatch between the investors investing for 5, 10, 20, 30 years, and insurance policy being one-year contracts, which they can adjust. I'm assuming, or does that vary? How do they price in, you know, how are they thinking about that whole?
Again, this depends on the investor and how far along they are on their journey of understanding, but you know, those who understand this are starting to pull that together, and that's pretty interesting for me. It's actually a really important dot to connect when you're making an investment, no matter what your time horizon is, right? So different investors, financial sector is not homogeneous. Different investors invest in different ways, different risk appetites, and different time horizons. If you are an investor who understands that climate risk is a financial risk, you're starting to ask about that risk, not just kind of for usually the term of your investment. Let's say you're a debt provider for 10 years, but also this year, next year, this quarter, next quarter, because you have to manage that risk in your portfolio, and you have to understand how that affects debt service coverage ratios, how your loan is going to be repaid, if you're a bank, whether it's an NPL risk, a non-performing loan risk, for example. And those things are really interesting. The data and analytics space that has also come about, partly because of the TCFD and other things, that is also helping investors figure this out. But the ability to toggle through time horizons is really, really important because climate change is not a far-off thing any longer, but anybody who's talking about climate change in 2050 is not really answering a question that an investor would have or potentially a homeowner would have.
Excellent. Thank you very much. Thank you to the panel. Give them a round of applause. Just one quick takeaway, the insurance industry has a big, big role in kind of helping the world deal with climate risk. It has done it in the past on other hazards. It needs to do more, like FM Global's doing quite a bit. And InnSure is here to kind of help the industry do more, help the startups, help the consumers of insurance, and help the world deal with these climate challenges. Thank you very much.
Thank you, everyone.